All right, today we are tackling a topic that, let's be honest, can feel pretty intimidating for a lot of people: investing. Our goal here is to cut through all the confusing jargon and give you a really clear, simple roadmap so you can get started with confidence. So let's dive in. Seriously, take a second. What would you do? If you're not sure, you are definitely not alone. For so many of us, investing feels like this exclusive club, a rich person's game, full of this alphabet soup of different accounts and weird terms. It just seems way too complex, way too risky. But here's the thing, it really doesn't have to be. Okay, so before we even whisper the words stocks or bonds, there is a super important first step. And nope, it has nothing to do with trying to pick the next big thing. It's all about building a solid foundation, something to protect you when life gets messy. And that foundation is your emergency fund. This is your personal financial safety net. The whole idea is to have cash ready to go so that when life happens, and trust me, it always does, you don't have to rack up a bunch of high-interest credit card debt just to get by. It's the buffer between you and a whole lot of stress. I just love this quote from a user on Reddit because it's so blunt and it's so true. Look, the stock market can be a bit of a roller coaster in the short term, right? A bit like a casino. And the last thing you want is to be forced to sell your investments at a huge loss just because your car broke down. This fund protects you from that. And this analogy just sums it up perfectly. Life is going to throw curveballs at you. A phone screenshotters, you need a root canal, whatever it is. Your emergency fund makes sure that when you stumble, you land on a nice, soft cushion instead of smacking onto hard, unforgiving concrete. Once you have that cushion in place, then you're ready to really get started. Okay, so your cushion is built, you're feeling secure. Now we get to the fun part. It's time to start filling up your investing toolkit with the basic building blocks you're going to use to grow your money for the long haul. When you boil it all down, most investing comes down to these three things. Just think of it this way. Stocks are about ownership, bonds are about lending, and mutual funds, they're about bundling everything together. Let's break them down real quick. So when you buy a stock, you're literally buying a tiny little slice of a company. You're a part owner. And if that company does well, the value of your slice can go up a lot. Stocks are usually the engine of growth in a portfolio, but with that high potential comes higher risk. Prices can swing up and down pretty dramatically. Now, bonds are kind of the opposite of stocks. Instead of being an owner, you're the lender. You're essentially giving a loan to a company or a government, and in return, they promise to pay you back your money plus regular interest payments. They're generally a whole lot safer and less volatile than stocks. All right, let's talk about that basket. Imagine trying to buy a piece of 500 different companies one by one. I mean, what a headache, right? Well, a mutual fund does all that heavy lifting for you. It pools money from tons of investors and buys one big, pre-made basket of different investments. It is by far the easiest way to spread your money around instantly. Okay, so you know the tools now: stocks, bonds, funds. But how do you actually use them? Well, that brings us to the two big philosophies in the world of investing: active versus passive. The biggest difference here really just comes down to your goal. Are you trying to beat the market, or are you happy to just match the market? Active investors are trying to be the heroes, right? They're picking individual stocks, trying to time the market, all to get better returns than average. Passive investors, they just want to capture the market's average return by buying a slice of everything and holding on. Now, the appeal of active investing is obvious. It's that chance to hit a home run, to find the next big thing and make a ton of money. But the downsides are pretty major. It takes a ton of time and research, it's generally much riskier, and you're going to pay way higher fees. And the data is pretty clear. Most active managers actually fail to beat the market over the long run. And that is exactly why passive investing is so popular, especially for beginners. It's simple, it's low cost, and it's a set it and forget it kind of strategy. Now, you're never going to beat the market this way, but you're pretty much guaranteed to get the market's return, which historically has been a really great way to build wealth over time. So, how do you actually do passive investing? The main tool here is something called an index fund. Think of it like a mutual fund, but it's on autopilot. There's no human manager picking stocks. A computer just automatically buys all the stocks in a specific index, like the S&P 500, to perfectly mirror its performance. It's cheap, it's hands-off, and it's instantly diversified. Okay, so whether you decide to go active or passive, there is one rule that is absolutely non-negotiable if you want to be successful long-term. This is probably the single most important part of managing your risk. And that rule is diversification. It's really just a fancy way of saying, don't put all your eggs in one basket. When you spread your money across different kinds of investments, stocks, bonds, maybe even real estate, a big loss in one area can be balanced out by gains in another. Think about the 2008 crash. The stock market tanked, but people who also owned government bonds saw those investments hold up, which really cushioned the blow. It just helps smooth out the ride. This is a question basically every beginner asks. I mean, if you're going to buy individual stocks, how many do you actually need to own so you don't have to worry about one single company's bad news totally wrecking your portfolio? Well, here's a pretty solid number for you. The experts say somewhere between 15 and 30 stocks in different kinds of industries can get the job done. But of course, this brings us right back to index funds, doesn't it? An S&P 500 index fund gives you a piece of 500 companies right out of the box. It really is the ultimate diversification shortcut. So let's wrap this all up. Here's your whole journey in 4 simple, clear steps. 1, build that cushion. Your emergency fund is non-negotiable. 2, get to know your basic tools. 3, pick a simple, passive strategy to get started. Index funds are your friend. And 4, always remember that golden rule: diversify. Look, at the end of the day, your financial journey is exactly that, yours. It's unique, but every single journey starts with one small step. Maybe for you, that's just opening a savings account for your emergency fund. Or maybe it's just doing a little research on a low-cost index fund. The most important thing is just to begin. So what's your first step going to be?